Good morning, everybody, and welcome to our November IFRS webinar. Now, in November, as we always do, we talk about getting ready for 31 December 2020 reporting season. As always, I have with me Kevin Frobers, who's our IFRS partner in Sydney. Morning, Kevin.
Good morning, Aletta, and good morning to everybody. I'm glad you've joined us again for this penultimate webinar of 2020. And boy, Aletta, it's been a long year.
It's been a long year for sure. But you can see that we have two guests with us, two guest presenters, two BDO partners, Nick Martin and Gary Poon, and the two of them will introduce themselves when they present their sessions. But good morning, Nick, and good morning, Gary. All right. So today's session, what will we be talking about? So we've got 5 parts. First of all, we're going to start by looking at directors' duties in a post-COVID-19 environment, and Nick Martin will talk about that. Then we'll talk about the ongoing financial reporting impacts of COVID-19 to kind of link back to what Nick has done. In the third bullet point, we'll talk about, so what's new for 31 December 2020 reporting season. And then the fourth point, we'll talk about a focus on the balance sheet. And we have seen during this year, a lot of entities might have struggled with generating profit during the year, and therefore maybe the focus at 31 December and during this year was the strength of the balance sheet. So are all our assets at the appropriate values, or are they maybe impaired? But also, have we captured all our liabilities that existed? So maybe a bit of a focus on the balance sheet, and Gary Poon will talk about that as well. And then finally, we'll end with what is on the horizon. So bigger picture, longer term, what's on the way. So that's what we'll be looking at today. So first of all, we kick it off with directors' duties in a post-COVID-19 environment. And I'll hand over to our guest presenter, Nick Martin, who's an advisory partner in Melbourne. I've put in his contact details and a little bit of his background. But Nick, I'll hand over to you.
Aletta, thank you for that. You might just flick past that. That's enough of looking at a photo of me. But I think you made an interesting point to start with, Aletta. And I think for those in the CFO function, there's a challenge of, or there's a tension often between the accounting issues, the commercial issues and the taxation issues, and they don't always align. And so in the last few months, there's been a real focus on the commercial aspect of finance, and I suspect there's been a secondary focus on the non-commercial issues like taxation and accounting standards. And so how do these issues coexist, and how do we balance them? Because for the last few months, as we've navigated our way through lockdown, there's been a real imperative to focus on cash preservation, cash burn, and building a capital base for the restart. And so what we've seen in the last little while is boards and leadership teams, and I include the group CFO function within that, that aren't necessarily using metrics that are relevant for the now. Sticking to accounting standards and accounting concepts and taxation issues wasn't the way to navigate your way through lockdown. It was all about having or developing some objective criteria, which were typically in and around working capital, cash preservation, being really clear around the expectations of your key stakeholders, because we know that the support from stakeholders, whether it's landlords or banks or suppliers, whoever it is, the benevolence is coming to an end. Now, whether that's via the government stimulus packages or there's an imperative for others in the supply chain to really focus on their own working capital, we need to be thinking about what are the absolute imperatives that we need to get right in our business. And conversely, and on the other side, what are the impediments to success in our rebuild? Be really clear on what those imperatives and impediments are. And so How have we reflected on the learnings of lockdown? There's a few bullet points there which I think set the scene and perhaps give people a framework to think about where we go from here, because ultimately, as directors or as members of the group finance function, we need to anchor our thinking now to what are the obligations of our directors, because ultimately they have a responsibility to exercise appropriate care and diligence. Now, how do you exercise appropriate care and diligence without reflecting on what we've learned through lockdown and then thinking about how we apply those learnings from here, not just up until the end of December, obviously, but I think there's a sort of a shift in mindset that we in the group finance function need to embrace. And so anchoring our thinking to what are the obligations of directors, because those in the group finance function need to be using that as an anchor point for what they do and what they're potentially going to do differently over the next year or two. So Aletta, what I've got on the next slide is just having a think about what are the changes and what are the impacts that we can have in the group function, the group CFO function, to assist directors in complying with their obligations. At its heart, directors should have signed off on a plan for this lockdown and rebuild process. So to what extent does the group CFO function or the CFO team understand the board's plan? Because a plan in isolation without reconciliation to three-way forecasts is going to have its limits. And conversely, whilst the finance function can develop its own models, hopefully three-way forecasts, to what extent are those three-way forecasts understood by the board? So we need to make sure more than ever that the left and the right hand are talking to each other. I also think that one of the things that we've learned over the last little while is the absolute imperative to develop and utilise non-financial KPIs. So a challenge for boards and therefore the CFO team, to what extent and how can you assist the boards alter their performance dashboards? And I'm not talking about the P&L, and I'm not talking about the balance sheet, and I'm not talking about the cash flow and the interplay between those three principles, but rather what are the indicators, what are the non-financial KPIs which we can develop? And for example, we know that the banks have provided accommodation over the last 6 to 9 months. How much longer will that last? Do we qualify? Do we need support? If so, what does that look like? And so it's not about preparing financials when it's all over. It's very much about understanding what are the levers of our business and what are these assumptions informed by those levers which ultimately drive whatever our forecasting model looks like. I think also we should be thinking about and recognising that our key stakeholders, banks, suppliers, landlords, employee groups, what's our communication going to be with them? So whilst traditionally we may have provided P&Ls, we might have provided balance sheets, what other information is going to be relevant to ensure that we've got the support of our stakeholders over the next little while? And irrespective of whether we are a business which is strong or we're suffering some challenges, we need to understand the ecosystem in which we operate. So, you know, the boards of landlords, the boards of the banks, the management teams of boards and banks and your suppliers are all wrestling with these issues. So how do we help them to make informed decisions which will ultimately assist us as we rebuild? Credit protocols, never waste the crisis. We've seen a lot of weak credit protocols. So to what extent have you turned your mind to how we're going to improve our credit protocols? That might be the ageing of debtors, it might be the ageing creditors, but it might also be how we secure advances that we make or unsecured credit that we provide to our debtors? To what extent do we understand whether or not we're consistent across our organisation? Really important that for things like delegation authorities, that we do have consistency and uniformity. I think there's an inevitability that the group's asset structuring strength is going to be tested over the next little while. So things like understanding the critical assets which underpin our business, what's their physical location, and to what extent do we have systems and processes to identify and protect assets which might be in a different jurisdiction or outside of our premises. Really important to be thinking about these sorts of things. What are we going to do when our covenants expire? So to what extent are we starting to think about the next 3 months to 6 months when our covenant or our facility review date falls due with our bank? How are we thinking about those sorts of things? What's the sort of information which is going to make our credit provider, the bank, how do we ensure that their life is easy? To what extent are we thinking about the deals that we want to do with our landlords? Because the landlords are far more sophisticated, become far more sophisticated in a very short time frame. The days of a landlord simply accepting an audited set of accounts, a bank guarantee, and a Dun & Bradstreet check, I think, are well and truly behind us. So what's the story, what's the narrative that we're going to give our landlord to help them understand why we need a different sort of tenancy profile? Because we're saying to landlord clients, you can't assess tenancy based upon revenue. Landlords want to be part of the solution, but they're not going to be the solution. So think more holistically about the sorts of data and information we're going to provide to our landlords. Working capital we've probably touched on in a way, but really understanding where we are, where the key stakeholders are in our working capital cycle. The ATO, we know that the ATO is a financier of sorts to businesses and can be to a fairly substantial extent. So understand that there are direct to personal liability exposures here, so we need to be alive to them. Insolvent trading, there's been a temporary moratorium which expires at the end of December. To the extent there are solvency issues, it's going to impact the audit, but it's going to have commercial implications beyond that. So we've got a very short runway of about 6 weeks until the end of December when the moratorium comes to an end, which sort of ironically lines up with the 31 December reporting period. So we need to be thinking about this stuff and interrogating the data, not through the eyes of the audit for this issue, but through the commercial lens. Safe harbour remains as a protection mechanism for directors. Do we need it? How do we know? Based upon what criteria? And ultimately, if we do need to start thinking about restructuring, are we thinking about restructuring the business, or is it the capital structure? And with all of that, it's really important that if it's a private company, it's the shareholders. If it's a larger company, it's the board. What's the alignment of thinking between the board and the CFO? What are the legacy issues which are going to arise? So whilst all of these issues may not be critical in and of themselves, other than the solvency issue, I think if we added up all the 1% that can have an impact on a business and use the lead time, I think that the CFO function, there's plenty of opportunities to refine what we're doing and add some material value to our working capital, our reporting systems, and the data that the board needs, because the board is probably going to be focused slightly differently from where they were 6 or 12 months ago. So let's think about how we can help them make better, more informed and more timely decisions. So a few thoughts, Aletta.
Nick, thank you very much for that. That was absolutely fascinating because as you were speaking through this and all the commercial reality and the things that the finance teams and also board members have to think about, I was already thinking, I could see Kevin get very excited about all the accounting implications, you know, when we renegotiate, you know, credit protocols, when we facilitate facilities with banks. You know, there's an accounting standard actually talking about that. I could see him thinking about rent concessions, and even Gary, I could see Gary's already talking about, thinking about, you know, there's this focus on balance sheets. We have to get the capital base right for the future. Yes, this year might look bad from a profit/loss perspective, but is our capital base good for the future? So there's a lot of overlays here. There's the business problems, there's the accounting treatment and the tax, and I think they come together beautifully. Nick, thank you very much for participating. I know you also have another commitment and you have to go, but we really appreciate you being here. And if any of our attendees would like to speak to Nick further about any of these, please contact him. Nick and I regularly work together with clients where we talk about, you know, the commercial reality, the tax reality, and then finally, how do we tell the story in the financial statements? And we're about to tell that story in 31 December financial. So thank you, Nick.
Thanks, Aletta.
Then if we move on to the ongoing financial reporting impacts of COVID-19, and I've tried to do this directly after Nick's section because there's a lot of touch points here. And, you know, in previous webinars this year, but also in our masterclasses, also in our virtual workshops, that's still running, by the way, we've been talking about these things. Now, I'll do a brief introduction and then I'll hand to Kevin to talk more about certain aspects. The very first one that I've put there is government stimulus measures. So as you know, recently in the budget, and even very recently in the New South Wales budget, there's a lot of government spending going on. And so how would an entity account for that? So I suppose commercially, Nick would say, Aletta, commercial thoughts first. You know, do you qualify for these commercial stimulus measures? Make sure you qualify, get help, get whatever money you can. But then how do we report it? And around government stimulus measures, it's usually a question of, does it meet the definition of a government grant? And therefore it's within IAS 20, an old standard, or is it government assistance that usually we just disclose? Or do we apply the income tax standard around it? But really important, do you qualify? Are you eligible? Make sure you get the money. And then how do we report? And what are the accounting policy choices available to report that? I would say around government stimulus measures, Kevin, the most interesting question we had recently were around if you receive a JobKeeper, and that JobKeeper is then, you know, and the purpose of JobKeeper is to keep your staff in your organization, keep them employed. But what if the cost of that staff is then capitalized to property, plant, or equipment, or an intangible asset, or even inventory, because the people are working on those assets? You know, how does that work? And it's really important to understand that the principle in our government grant standard is a matching principle. You know, old-fashioned matching is still there in IAS 20. So if you are only going to recognize your JobKeeper or your government grant in the same period that you're going to recognize the related expense, that's the overall principle. Therefore, if you receive JobKeeper in December, but you've used the salary or you've used your staff to create inventory, and you're only going to sell the inventory in April next year, and therefore you'll only have cost of goods sold in April next year, JobKeeper will only be recognized in income in April next year. So that was one of the big tricks that we've run into recently. So I'll just flag that with you. The second one that I've got there is rent concessions. Now, Nick touched on it. Landlords are coming to the party, and there are codes in place that they have to negotiate in good faith. So whether you're a landlord or a tenant, make sure you get you do the negotiations, you get to agreement, and then consider, how do we tell the story in our financials? If I'm a lessee, what concession did I receive? And think commercially, what are the options in the accounting standard? Do I book it in profit now, or do I defer it over the period of the remaining lease term? and then obviously the opposite to a lessor. The next one is also modification to leases. So we are seeing a number of lessees and lessors that are using this opportunity to not just talk about rent concessions, but really rethinking the whole lease agreement. In particular, tenants are saying, people are working from home. I don't need them in the office, or they're working from anywhere. I don't need them in the office. Do I still need all the leases that I currently have? So they're restructuring their lease portfolio. So it's really a lease modification and not just a concession. How do we account for that? How do we tell the story? The next one Kevin will talk about around renegotiation or modifying financial instruments, bank loans. I know there's a special slide on that. There's also a slide on convertible notes. I think with the global financial crisis a number of years ago, we saw an increase in the use of convertible notes, and I think we're seeing the same thing now. Impairment of assets, so that would be financial and non-financial assets, whether our property, plant and equipment, our investment property, our inventory, all our assets, the non-financial assets in that balance sheet, whether they should be impaired or not, get that capital base right for the future and the capital structure. But also, if you're a lessor and you've got a non-financial asset like a lease receivable, will you be able to collect that in future? Do we need an ECL? And what's the size of that ECL? Recognition of provisions. Recognition of provisions to make sure that we've captured all our liabilities. Have we made sure that we've got the valuing of that correct? And also, when you adjust that provision, the credit side, make it more or less, what do we do with the debit side? And looking at the old lovely interpretation 1, IFRIC 1, on how to do that. Kevin will also talk about modifications to share-based payments and employee entitlements. It might be a time where entities say we have to rethink what are the thresholds and how do we remunerate our staff. And then finally, Nick talked about going concern and very important compliance with our covenants. Are we complying with our covenants? And if not, we have to renegotiate this before reporting date. Otherwise, it creates issues for us. If our reporting date is 31 December as an annual reporting date or even an interim reporting date. So this is very high level. I think the things we've been talking about over the last 6, 7, 8 months. But Kevin, I'll throw over to you for a few slides where you're going to zoom in on some of the practical things that we've been dealing with recently.
That's right. Thank you, Aletta, for that summary. And I will say, once again, Aletta, you know me too well, because as Nick was talking, you were right. You could just see my face light up, because everything on our list here, which has been prepared, which was on the previous slide, really does have a link to what he was saying. And I have to say, in my career, accounting was always the last thing people used to think about after tax and then after the financial and commercial aspects. But I must say, and this goes to what Nick was talking about earlier, it is encouraging to see organizations and boards and CFO actually starting to look at all of them together, and they really are starting to ask questions about how they interact. So that's the one observation. But the other thing is government stimulus, rent concessions, leases, impairment, provisions, and going concern. They were all topics that were on our list the whole year. And we had sessions planned in terms of webinars and accounting news. Even last December, we planned those webinars even before COVID hit. So I'd like to say that they're all relevant. There's lots of material out there for you to go and have a look at. And so the ones we've chosen today aren't going to be government stimulus, rents, modification, and so forth, because there's so much content on our webinars and in our accounting news on those. The ones I'm going to focus on today are share-based payments, modifications to those, convertible notes and bank loans. And the link to Nick was that these are all commercial decisions that are being made by organizations right now. The convertible notes and the renegotiation of financial instruments, that's essentially driven by cash flow and cash flow needs. But what is interesting is that that boards are coming to us before they sign in these agreements to make sure they understand the financial impact. One, because of the story to those financiers, but also because they're starting to protect the balance sheet. And that's really encouraging because they can see the benefit of considering all the options before they go at it. Share-based payments are slightly different. This is about changing your KPIs and protecting your employees. Also a point that Nick touched on, because the point that is being made here is that share-based payments, a lot of these were actually locked in before COVID hit, and the idea of protecting the employee's remuneration and essentially their interest is a key component of reacting to COVID-19. People are important, and you want to protect their mental health, but also to make sure they're fairly remunerated in what has been a very difficult year. So this is one of the change in expectations that is coming through. Now, I've seen about 7 of these in the last 4 weeks. This is where, before anybody jumps as to changing share-based payment awards, boards are looking at this and saying, all right, what did we promise to our staff and our people before? What's going to happen? And should we actually look after their interest and amend our share payment awards, because the expectation of how these awards vest has been changing. This slide is one I don't think we've really seen before, because normally what happens is we get a call once they've made the change and they say, oh, help us with the accounting. But what's actually happening here is what's actually changed in the market, how does it impact the actual expectation of the employee and what they're going to get, and how can we amend it to benefit them? That's really, really key step. Before you do anything, understand what's changed and how does that benefit your employee. And that goes back to Nick's point about KPIs and resourcing. And it's a really healthy, it's a healthy thing to look at. So the first thing to do if you are looking at your share-based payment awards and whether to amend them is understand the change in expectations of what's actually happening in the market. Now, most of our share-based payments are driven by three conditions, and there are a couple more out there, but these are the three main ones. Service conditions, non-market performance conditions, such as I almost want to call those the non-financial ones. It's not exactly all non-financial, but things like you get the award vests if you have a successful IPO or something along those lines, and then the market performance conditions, which are in green there, because that's the one we're seeing a lot of share-based payment awards, especially in the listed environment, were set where the CFOs or the employees were remunerated or vested based on whether a share price was met. And let's face it, the share prices are not climbing to what was expected. Some of those awards are just never going to vest because they're never going to get the target market price. And ultimately, what's happening is this has to translate into an accounting answer somewhere along the line. And the first thing is to understand what happens. Most organizations think that if these conditions are not going to be met because of a change in expectation, that they get to reverse the expense. And that is not how it works in IFRS 2 or ASB 2. So share-based payments, if you're coming up on this for 31 December and you've already started this process, or you've already jumped into an amendment of an award because of COVID-19, you need to understand what's going to happen to the accounting. And the first thing is that you don't, generally speaking, you don't get to reverse your expense if you're amending some of these things. And this is especially true for the market performance conditions. There's generally, with your market performance condition, there's not really going to be much of a change in the accounting if the condition is not satisfied. And you need to be aware of that before you start to make amendments. You first need to understand that the vesting is essentially not going to make much of a change in that block. Now, if I can jump to the next slide a little, this is the one I actually wanted to talk about today. This is your 31 December 2020 replacement awards. The 7 calls or queries that I received in the last couple of weeks were all about replacement awards. What's actually happening here is the biggest shift that we've seen in share-based payments is I have given my employees an award. It was based on achieving a certain target share price. We're never going to achieve that share price. The employees aren't going to actually ever have these awards vest. I'm looking after their interest. The KPIs are changing. I want to look after their interests and make sure that they get some benefit from there. So what I'm going to do is I'm going to amend the award that they had and essentially lower the hurdle on the share price that needs to be achieved for them to get this award. That's noble. We love it. That's what you're supposed to do. The first thing is that I'm glad that all 7 of those queries were queries before they amended the award. So that's probably the biggest thing I could say to you is before you do anything, before you change anything and agree to a change, is ask the question, what's going to happen? What's going to happen to my accounts? What managements tend to want to do at this point is they're going to say, all right, we're going to issue some new awards here. We're going to lower the target price. And what they want to do at that point is they actually want to reverse all the expenditure that they've recognized up to that point, and they want to account for the replacement award as a new share-based payment. But it's ultimately the reversal they're looking for, because in their mind, if they making the old one go away, surely we can reverse what we've done, and that's not necessarily how it works. In fact, that's very, very seldom that's how it works. So what I want to put on the table is the mistakes that are being made. Replacement awards, and the reason why I've put it in inverted commas is because we need to know what we mean by replacement awards. Replacement awards, in the language of the accounting standards and IFRS 2, a replacement award is one that's essentially been formally designated as a replacement award. Just because you think you're replacing one because I took that one away and I put this one in its place doesn't mean it's a replacement in the accounting standards. So you need to first of all actually understand and draw a line between what's a replacement in terms of the language of the board and the employee, and what's a replacement in terms of the accounting standard. Now, not formally designating an award as a replacement in the accounting world, and that would include disclosing it in the financials, means that the old one gets treated as a cancellation. But that doesn't mean you get to reverse the expense. What that does to the old award is accelerates the vesting of the old award, and you end up with a rush to expense everything you haven't yet expensed on the old award. That can be devastating to the profit line if you don't get that right. And notice, that's because you didn't formally designate it as a replacement award. In other words, you didn't make it clear to the employee and you didn't make it clear to the market that it was a replacement. What happens is you're essentially punished with an acceleration of vesting and an acceleration of expense. So this is one of the biggest things I'm seeing. As I said, 7 queries in the last couple of weeks, and so I'm putting it on the radar because I think it's something that boards should really take on board before they rush off with this. But interestingly, if you do formally designate this as an award, how is that treated? Well, it's actually treated as a modification to the original grant. So also, once again, it's not a cancellation or a rescinding of the old one and an issue of a new one. It actually just modifies the old one. And what actually happens here is at a minimum, you're going to still end up expensing the original grant value that was assigned to the original award. In other words, the key message of this slide is you're not going to get to reverse your previous expenditures. You're going to end up still, because the reality is you have granted an original award, it must still be accounted for. And then the other thing is there are a number of accounting alternatives that can arise here, but the key reason why this replacement activity is happening is because we want to still give a value back to the employee, the value that they get that's been lost by the idea of a share price reducing. The important thing here is that often gives rise to a beneficial gain to the employee, and you may actually end up with a situation, depending on how these things are structured, where you actually have the original vesting period and a new vesting period on the replacement award, and sometimes they're actually accounted for separately to achieve the expense through profit and loss. So I won't spend much time on this because hopefully I put the fear of God into you just with that. But I'm just saying, put that on your radar. With 31 December, don't be caught by share-based payments and not considering the impact. Convertible notes, this is a 4-hour training session if you really want to. So I won't spend a lot of time here, but this is all linked to cash and the things that Nick were talking about in terms of raising capital, debt pricing, and Gary will talk about balance sheet protection coming up. But I just want to put on the radar is there is still a perception out there that if I haven't got anything but my equity to give and I need cash, what I'm going to do is I'm going to issue a debt instrument or a convertible note because I can get the cash now, I need the cash, I need to protect my working capital, and that's just going to cost me some equity later. And I don't know if it's because we train everybody at university that a compound financial instrument is the answer they always have. So you issue the convertible note, you have a bit of a liability component, and you also have a bit of an equity component. Everybody runs to, we've got a compound financial instrument. I just want to place on the radar that hybrid financial liabilities are also a possibility. In fact, most of the convertible notes I see end up being hybrid financial liabilities, which don't have any equity component. They're all liability and derivative liabilities. And this is something that comes as a galloping shock to a lot of boards. They issue a convertible note, they get the money, and they're expecting to see something go to equity at that point. But what ends up happening, the entire amount goes to liability. And I'm going to stare at Gary a little bit here because Gary's going to talk about protecting your balance sheet, and this is one of the worst ways to do it. So I'll leave it at that because I don't want to steal Gary's thunder coming up later on convertible notes. But before you jump into convertible notes, and if one of your objectives is protecting your balance sheet, just have an understanding of what the terms do, because you may end up in hybrid very quickly. And this slide is all about the fixed for fixed rules. It's one of the key rules in financial instruments. If you're not issuing an instrument, a fixed number of shares, let's say, for a fixed amount of cash, you're most likely not going to have equity. That's the general rule. It's a very general rule. I mean, it's very general, and that one you can actually get caught on very quickly. And then finally, I think it might be finally, but we'll head to renegotiating bank on other loans. This is not so much a killer to the balance sheet, but it is something that comes as a surprise to a lot of CFOs and finance teams, and sometimes the boards, when you're renegotiating a bank loan or another financial liability, as a lot of organizations currently are, and if it's done, let's say, before the 31 December, you need to understand the accounting. A lot of organizations, similar to the share-based payment, they think they reverse the old loan and put the new loan in. It's the same type of concept. Not always. If you're renegotiating with a third party and the modification to the terms is substantial to the previous terms, then you get to de-recognize the old one and then re-recognize a new liability. But if it's not substantial, what actually happens is you just modify the cash flows and redo a discounted present value at the original discount rate of the loan in the accounting. And the answers can be very different, because the one's a derecognition and a re-recognition, and the other one's just a modification of the balance on the balance sheet. A couple of clients have been caught out by this. Look, their main purpose here is to raise cash and to or to defer payments in a COVID world. That's fine. That's the main objective. But it does come as a surprise sometimes that the effective interest rate on the loan actually hasn't changed, and that they get a different P&L answer than they were expecting, because a derecognition and a re-recognition or a restatement of an original loan can give different answers to profit and loss, and you just need to understand that, because it obviously has a carry forward into your financials. So those are the things I just want to put out there as things to think about. And with that, I'll hand back to you.
Thank you very much, Kevin. And that was a nice, perfect match of what you and Nick were talking about. Thank you for that. Now, for 31 December 2020, if we go to the accounting stuff, so what's new for 31 December 2020? I would have to say the good news is not much new. I think all the COVID drama is enough for all of us. Therefore, the first thing I would say is the good news. Earlier this week, ASIC has issued an extension of reporting deadlines. So for 31 December 2020 reporting, they've said, people are still working remotely, struggling to get access, potentially struggling to finalize financial statements, and therefore an extension. In our November newsletter that's being issued tomorrow, there's an article on this. The last two bullet points are the key ones, and that is, if you are a foreign registered entity, these extensions do not apply to you. Similar to 30 June, these extensions did not apply to foreign registered entities. And also, if you're a listed entity, um, the fact that ASIC is granted an extension does not necessarily mean that the ASX will do the same. Now, for 30 June, they did do the same. They ended up issuing a class waiver. That's not in place yet. So usually ASIC does the extension and then the ASX decides to follow or not. And we would expect them to follow, but it's not been done yet. So again, we've got extension of reporting deadlines. Important to note that ASIC did indicate, where possible, that you should continue to lodge with the normal statutory deadlines. What we have seen is that most listed entities try to stick to the original deadlines. I think it's about communicating to the market in a timely fashion and that we've got everything organized and we're on top of this. And listed entities have to report every 6 months anyway, and there's continuous reporting obligations. So I suppose if you start to push out deadlines, it becomes difficult. So I would expect listeds to do a similar thing again, but this is more there for potentially assistance for our unlisted entities. If we then look at, 31 December, what are the things to do? I would like to put in a reminder to do a post implementation review of the standards that we have implemented or you've implemented recently. Now, last month we talked about IFRS 16 and all the ongoing complications and the fact to reconsider critically whether you are in a position to manage this on an ongoing basis. Did you just at 30 June 2020 accidentally fall over the line with all kinds of Excel spreadsheets floating around? Or is it now the time to really get a hold of how do we manage this on an ongoing basis? We've discussed that last month, but I'll put it on the radar to have a look at that. I would also like to put on your radar IFRIC 23, uncertainty over income tax treatments. Now, we've talked about the need to work with tax professionals to assess whether we've captured, whether we have a risk register of all our uncertain tax positions. Do we have risk register? Do we have position papers? And therefore have documentation to speak to the auditors. Now, this is an ongoing thing again. At every reporting date, what uncertain tax positions do we have? And then the last one that I've included there, because Kevin and I are dealing with a lot of them at the moment, are IFRS 15. Now, revenue recognition obviously is critical to any business. That's the start of it all. We have to generate revenue to have any chance of having a profit. And IFRS 15 has really upset the apple cart. There's new rules, but it's a constant thing for every new contract that you enter into with a customer, whether you've addressed the 5 steps and whether you've got the recognition correct, have you looked at the performance obligations, whether you recognize revenue at a point in time or over time. So just keep that on your list. Then for our not-for-profit entities, I've put in AASB 1058, the income of not-for-profit entities. That is, again, similar to IFRS 15. Every time we get new funding, a new bequest, new government grant, we have to assess whether we're in the scope of AASB 1058, whether we're in the scope of AASB 15, how do we recognize the revenue? Do we have a process to an ongoing basis look at these? Because not-for-profits always or often have bespoke funding arrangements. So that's another accounting standard that's here to stay. Kevin, on the next slide, you wanted to talk about a phenomenon that we're seeing at the moment, termination for convenience.
Yes, thank you, Aletta. And I snuck this one in at the last minute last night because it's close to my heart. A little short story is about 18 or maybe even 24 months ago now. We started to deal with this in some of mine and Alette's research institute clients. So this is where the university attached type institutes who get research funding deal with research grants. So it started in the not-for-profit sector, but it has spilled into the profit sector as well, which is why I've put it on the radar, because it actually has far-reaching implications, and that is because it's common to a lot of government government contracts. It's not necessarily government grants, government contracts. Now that's important. There's a lot of money sloshing around at the moment because of government stimulus from all levels of government. So we are seeing this. It previously existed, but it's starting to have far-reaching implications because a lot of government contracts have them. The termination for convenience is essentially a clause that gives the right to, often to the government, to call back unspent funds without cause, essentially to conveniently take the money back that hasn't yet been spent. That has created an enormous question in the industry about whether grant type arrangements or money that's been given and might have also been recognized as a government grant into income, or in a not-for-profit, it might have been taken to income immediately, whether the unspent funds actually needs to be a financial liability because it could be called back. That's where we started. And I must admit, I've been entrenched in view one, which is recognize the unspent as a financial liability for quite some time. But it isn't that simple. In fact, it's far from simple. Now, here's why it's close to my heart. Over the 24 months, I've gone through every stage of craziness, from I know the answer, I'm certain, to I don't know what the hell's going on at the moment. And it's been up and down, to the degree that this has now arrived at the Australian Accounting Standards Setter in their latest meeting, where a number of other views have been put forward, such as there's no liability until the money is called back by government, and even an alternative view, which means that if you've got a revenue contract with government, whether you've got a refund liability. And a refund liability is measured very differently to a financial liability, so the answers can look very different. They're both liabilities, but the measurement of them looks completely different if you go down these paths. Why I've put this on the table is because this is going to be an issue at 31 December if you haven't already spotted it, but it won't have an international interpretation on it at 31 December, which means you should probably seek some assistance on this if you have these. So I'm putting this on the agenda because you are probably, as an industry or as an entity, going to need to take some type of educated management judgment for your 31 December accounts, and you need to keep your eye on this next year. Once this issue, which has gone to the local account and standing setting board, it'll probably get elevated to an international interpretation at some point, which means it'll have some time to go before we have an answer. But 31 December 2020, you're going to have to put something in place to answer this question. Aletta, I'll hand back to you. I know we have a lot to get through.
Thank you, Kevin. So I've put here, so what is new? We've talked about all these new issues around existing standards. What is new for 31 December 2020? And the only real big item is amendments to the definition of a business in IFRS 3, business combinations. Now, the key changes are that there's an updated definition of what is a business. There's also the introduction of a new optional concentration test. So you don't have to do it, but you could if you want to. So, in accounting standards, Kevin and I like options. We like practical expedience because it means that clients can model and think about what are the implications, what are the alternatives, what do I want to do here. So I like options. Gives us more place to work with around advice. And then also there's supplementary guidance added, including additional illustrative examples, a large number. Important to know that this amendment to IFRS 3 is applicable to annual reporting periods beginning on or after 1 January 2020. Therefore, if you're doing an annual period of 31 December 2020, you'll be captured. But even if you do an interim period, you'll be captured. So this is the year that this standard comes in. So why is it important to distinguish and look at this new definition and these amendments? Because we know that the accounting outcome is very different whether you've got an asset acquisition or a business combination. So there's a lot of different things that's happening, whether we recognize goodwill or not, what we do with transaction costs, how we recognize our assets at fair value or not, what we do with NCI, what we do with deferred taxes. So this is a very important thing. Do I have a business combination or not? And in order to know whether I've got a business combination or not, do we have an acquisition of a business? So it's not an acquisition of a business. It can't be a business combination. And a lot of these things, the answers are quite different. So this is an important change. when we look at the amendments to IFRS 3, we looked at 5 key amendments, and I'm going to touch on them. And in the new year, we're going to look at more detailed training, a whole session on IFRS 3. But I wanted to touch on them briefly. It narrows the definition of outputs and a business to focus more on returns from selling and services to customers rather than cost reductions. The second one, it amends guidance on what is an input, what is an output, what is a substantive, what is an input, what is a process, when do we have a substantive process, and also outputs. So we've got new definitions. It clarifies that to be considered a business, an acquired set of activities and assets must include as a minimum an input and a substantive process. So obviously guidance on what is that substantive process, that together significantly contribute to the ability to create outputs. So that's a change in what we look at for a business. It also provides extensive guidance on what is meant by a substantive process, because we now need an input and a substantive process. It's not talking much further. And then it adds this optional concentration test. So those are the 5 key amendments. Now, originally, I was, as always, very optimistic, and I've included a discussion on each of those amendments. I've included the old definition and the new definition of a business and an output. I've also looked at the fact that an input and a process together should give us the ability to contribute to the creation of an output. And what would that mean? And I've even put in some examples. Now, I don't have time for that today. So I've also, I've looked at the 5 amendments, I've given you some examples, and I'm just going to go through them. Happy for you to look at that. I think important, if you've had a business combination or an asset acquisition, and you're not sure whether it's a business combination or an asset acquisition for 31 December 2020, please look at these slides very carefully and contact Kevin and I, and we can help you. So we want to put it on your radar, but we don't have the time to look through the details necessarily today. But I do want you to know that there are new definitions, new rules, optional concentration test. Just be aware. Early in the new year, Kevin and I will do a whole session, an hour just on that. And we've actually arranged for a corporate finance partner, Mark Chavallo, to join us to talk about the commercial angle on why this is important and what they see at the moment in the market. Therefore, in the last 8 minutes, I'll hand over to Gary Poon, who's very patiently been waiting, our tax partner, to focus on the balance sheet. Gary, so I'll hand over to you. And Gary's going to talk about negative net asset positions. And if you have this at 31 December, what can we do about it? This is a big practical issue.
Thanks, Aletta, and thanks, Kevin. I certainly learned a lot in the last 40 minutes about accounting, more than I'd have in the last 10 years. So, and there's a lot of commonality actually across the whole session on the focus on balance sheets and what can be done to provide a bit of strength. So this particular issue has come across my desk probably 4 or 5 times this year, and so I thought it'd be useful to to bring to light what we see and where the issues might be. So negative net asset balance sheet, or a situation where your balance sheet's heading that way. That clients that have come to us have all provided similar reasons as to why it's triggered their thought processes to have somebody look at it. They've all been concerned about the perception, having this balance sheet in this state, what it means for them as directors. Sometimes it's a case of suppliers being concerned. The accounts need to be provided to suppliers in case they can't get paid, and sometimes it's clients, whether the business is going to be around long enough for that service or goods to be provided to the client. So there's many reasons why directors do want a stronger balance sheet, and where this situation's come up typically is partly because of COVID. In a lot of cases, businesses have suffered and they've had to ask for more help from their shareholders or from lenders. And sometimes it's also a case of not projecting what their capital and debt requirements are, or not being able to accurately project it because things have changed. Again, some of it would be COVID related, but that's not always the case. So I've actually drafted an article, and there's a link provided down the bottom, which is available on our website, which goes into the whole topic in a lot more detail. But the problem, for all the accountants that like to look at balance sheets, there's a balance sheet there. It's not pretty. You've got more liabilities than assets, and the other side of that, the equity section, is because a lot of the money that's been obtained, or some of the money that's been obtained, has resulted in operating losses. So the question then is, well, if you're in this situation, what do you do about it? Now, Aletta, if I could just ask you, I've got some polling questions. I was wondering if you could make that available. So I've got a couple of questions here for everybody, if you don't mind answering. Is, do you have this situation in your business where you've got a company that's got a negative net balance sheet? And if you can answer yes or no to that, and then move on to the next question, which Aletta hopefully will be able to provide.
Gary, I'm just going to let it run a little bit at this stage. We've got a really large audience, and at the moment we've got about 30% of the attendees have voted, so let's give them a little bit more time. Yeah, definitely balance sheets under pressure, Gary. And, when directors look at this balance sheet with negative net assets, I know auditors look at that and say, do we have going concern issues? Definitely. And earlier we talked about the accounting assessment around going concern. We talked about, are we in breach of our covenants? And the other thing that also adds to this is that beautiful Lisa standard has added a lot of liabilities to balance sheets recently, and maybe some of our assets have been impaired recently. So there's a lot, and COVID, obviously, there's a lot of contributing factors here.
Yeah, absolutely. And sometimes the trigger for a conversation isn't just the directors have seen it, or the CFO seen a balance sheet, or has monitored their balance sheet to that situation. Sometimes the trigger for the conversation actually has come from our audit colleagues and people like yourself, Aletta and Kevin, where these questions have come through from an accounting and a commercial perspective. And then the next question is, well, what happens from a tax perspective?
So a large number of people have actually voted, so you should be able to see the findings there, Gary. If you look at 19% of the people on this call or on this webinar actually have an issue around negative net assets. Really interesting.
Yeah, so there is. It's certainly not a trivial and ad hoc situation. Seems, in terms of the population, that's a reasonably significant number of businesses in that situation. So Letta, if you can, flick over to the next poll question. So this question is really a case of, well, if you want to do something about it, do you have a situation where the liability section is driven by a shareholder or a related party loan? And if the answer is yes, maybe there is something that can be done. Whereas if it's an external lender like a bank, that would be a lot harder to manage. And I think that second situation is back to what Nick was talking about earlier in the webinar, that you would have to look at other levers to try and remedy the issue.
Yeah, and Gary and Kevin, the other one we've seen is, if we want to get rid of these liabilities, Kevin, how do we repay with issuing our own equity or shares in the entity potentially, or is it convertible notes? A lot of things come to mind there, and accounting consequences actually.
And actually, I'm going to make it complicated. If you haven't voted yet and you don't have a shareholder related party, a couple of things I've seen in the last few months is I issue convertible notes, the notes convert, and then I get a loan from that person, which means I suddenly have a shareholder loan. So you might not be in this situation now, but 3 steps down on the chessboard, you suddenly got a shareholder loan, because what you did was you you issued a loan to an external party, it converted, and then you needed more money from that person, and suddenly they're a related party or a shareholder loan. So don't think this not going to apply to you. This can be 3 steps down on the chessboard from you. You're going to be answering yes to this question.
Yeah, absolutely. That is very interesting. Gary, I'll share the findings for you so you can talk to that.
Well, that's interesting that half the respondees have said yes, and 49% say half, and half have said no. So that there's a large population of the attendees that have related party loans or shareholder loans, and so if they can get through COVID and they are well capitalised already, maybe this will never come up. But for those who might end up heading that way or are already in that situation, I think that the next slide actually might be useful as to the examples that have come across my desk as to, and they're probably the easy examples of how it's typically resolved. Now, these 3 examples aren't necessarily, they might work from an accounting, well, I won't say whether they work from an accounting perspective, but I've seen them done this way. And they may or may not work from a tax perspective either, but if you do it wrong, there's lots of, there's sometimes quite severe tax consequences if the numbers are quite big. So first example there is you write off the loan to the P&L. Rightly or wrongly, I've seen that before. Second example is the loan is effectively written off, but there's no shares issued. There's just a credit to equity through some sort of reserve account. And the third example is the loan again is written off, but shares are issued. All 3 examples have tax consequences, and if they're done poorly, then it can be, in my example, 25 million. That's a pretty severe tax consequence if something was wrong on that front. So this is just for all the attendees to keep in mind that if you're in this situation or you want to consider these solutions, one of these solutions is really to probably have a chat to your tax advisor or call me and can work through the narrow pathway that you can go down to tick the box for tax, and obviously you should speak to a letter Kevin to make sure it also works for accounting as well, and that the directors are happy and the auditors are happy before you press the button, because if you've done it already, it's a bit too late to unwind the clock and try and fix it. So Aletta, I think I've taken up more than my time. I'll pass it back to you if there's no comments, no other comments.
Thank you very much, Gary. And I can see Kevin is really biting on his teeth. He knows he wants to say something, but he's looking at the clock and he says, I can't say something. So I'll do it, Kevin. Accounting consequences here, everywhere. It's not just a simple journal, get rid of the loan and credit again, or credit a contribution reserve or issued capital. There's all kinds of other complications. I think we've just put it there for an illustration purposes, that to get the conversation going around, don't think it's
I'll be a techie here as well, because there is an interpretation that deals with these types of situations, but it kind of doesn't cover related party shareholder loans. There's a hole there, and so there's a hole. That's in the accounting as well. So not only should you be looking at this from a cash flow from review, from a commercial aspect point of view, but the accounting is also somewhat vague.
Absolutely. So I knew we wouldn't be able to say nothing. We've been working together too long, Kevin. Then on the horizon, so what's on the way? IFRS 17 around insurance contracts. Years beginning on or after 1 January 2023, absolutely on the way. I've included links there to our BDO publications, newsletter, articles. The interesting thing about IFRS 17 is, don't think it's just if you're an insurer or insurance company. It is for insurance contracts, right? And any entity could have those. So have a look at that. Sustainability reporting, doesn't matter whether I open the paper, when I'm on global committees, wherever I go, everybody talking about sustainability reporting. And how does all of this impact the environment, climate change? How does it impact organizations? How does it impact financial reporting? I had an interesting question this week. A client said, Aletta, is it too early to disclose something about this? So it's never too early for disclosure. And then we know the International Accounting Standards Board or the IFRS Foundation is looking at what they're going to do about this and a potential new standard. And then there's an ED or a discussion paper out, goodwill to amortize or not. We talked about it last month, but I couldn't help myself to put it back on the agenda. I know when I started my career, goodwill was amortized. And then we went to an annual impairment test, and the debate is back on the agenda for sure. The other real big thing in Australia is that come December, or come 31 December reporting period, we have a new AASB 1060 that's talking about simplified disclosures. So there's two big things happening. We're moving to general purpose financial reporting ASAP. And that train has departed the station and it's gathering speed and momentum. But together with that, the AASB is replacing reduced disclosure requirements that is in every little standard with one standard AASB 1060, simplified disclosures. Now, BDO is very excited to launch a new technology solution around that, AASB 1060 simplified disclosures during our December webinar. Interesting, we looked at all the disclosure requirements and all the transition methods, and we came up with simplified disclosures has a nice round 700 disclosures in it. 700 potential disclosures. And the only way that you can cut it down is if you consider scoping questions. I don't have investment property. I don't have property, plant and equipment. I don't have XYZ. So we've come up with a way to tailor it for organizations based on scoping questions. So we'll look at that in December and talk about the transitional options. And I'll just say this, if you transition early, because it's not mandatory yet, there's a lot of benefits. If you wait till the mandatory date, it's problematic. So, I think that'll be a good webinar to look at. Do you need assistance? You can go to our website. We've got a new section around our audit ready services, and it's all around if I want a very smooth audit and not working the ridiculous hours as a finance team. We want a smooth process. It's all about preparing for the audit, and the kind of things we can help you with is putting position papers together, help you with the different options within accounting standards. And we can even help you with discussions with your auditors. Very important, we have to look at independence, so non-BDO auditors for that discussions, but even internally, if we have appropriate Chinese walls within BDO, we can help you with that. We have a fresh eye when we look at your financial statements. And I think the second point is very important there, and that is commercial outcomes while still complying with Australian accounting standards. Kevin and I like it when accounting standards have practical expedience, options, accounting policy choices, because that bullet point around commercial outcomes come to life for us. So it's all around how do we help you to prepare for the audit and save you, the audit team, some effort and some time. If you're looking for assistance, we've got 4 IFRS partners across Australia. Please feel free to reach out to any or all of us. We would love to speak to you. This is just a bit of an overview of our team across Australia. And then finally, I would like to say thank you very much for joining us today. Particular to you, Gary, it was wonderful to have you here. It's always nice to have partners from other service lines. And if we can find that common passion, always great. And I think we found a common passion around the emphasis on balance sheets. Kevin, as always, lovely to have you here.
And to you too, Letta, and goodbye, Gary, and everyone on the webinar. See you next time.
Thank you very much, everybody. Goodbye.
Thank you. Bye.